And these are very, very serious things, which I think are likely to push the U.S. And the world. I mean, Europe is already in a recession, and they're likely to put U.S. in some kind of recession 6 to 9 months from now.
Jamie Dimon just gave a frightening economic prediction while visiting Davos for the World Economic Forum. His forecast, which is shared by other highly respected economists, puts the US in recession within a few months as $1.5 trillion of consumer liquidity is drying up fast. Today I'm going to be breaking down some new clips from Jamie Dimon where he explains his economic predictions for 2023 and of course what it all means for investors today. Jamie Dimon is the billionaire CEO of JP Morgan, a position he's held since 2005. Dimon built his $1.8 billion wealth almost entirely at JP Morgan, with his 9 million shares in the company worth over $1.2 billion today. Every now and then, Jamie Dimon gives his outlook on the stock market and economy, and he's one of the few people that I listen to on macroeconomic issues, alongside Ray Dalio and Howard Marks. Last week, he sat down for an interview with CNBC while attending the World Economic Forum in Switzerland. The event is a week-long conference where thousands of investors, economists, and business and political leaders gather to discuss global issues across a series of sessions. And it's one of the few times that we actually get to hear from some of the greatest minds in the world of finance. In his interview, Dimon indicated that he believes the US is heading for a mild recession in 2023.
But the real issue for the world is Russia, war, Ukraine, energy, trade, and that is serious. And that's still out there. Hopefully it'll mitigate and go away, but it may not.
He cited the war in Ukraine, the US-China relations, and inflation as 3 key factors that could lead to an economic downturn in the near future. And in another relatively recent interview, he actually also gave a timeline for that recession, suggesting that it will begin within 6 to 9 months.
It's rates going up more than people expected already, and probably a little bit more from here. It's QT, which we've never had before. So therefore the unknown effects, and you see it today in bond markets around the world and sovereign markets and people selling U.S. Treasury debt, and it's the war. And these are very, very serious things, which I think are likely to push the U.S. And the world. I mean, Europe is already in a recession, and they're likely to put U.S. in some kind of recession 6 to 9 months from now.
Dimon views the ongoing war in Ukraine as the biggest global issue right now, not just in terms of how it affects the economy, but also how the outcome could set the tone for geopolitical issues going forward over the next few decades.
The only thing that matters for the future of the world is how this thing plays out. Russia, Ukraine, and the humanitarian crisis. When I wake up every day and I read the missiles going into buildings and killing kids every day, and it's nuclear blackmail. This is the most serious issue, and in my view, it could be an inflection point for the Western world 400 years.
Just last week, Russia's deputy head of Security Council stated that the loss of a nuclear power in a conventional war can provoke the outbreak of a nuclear war. Nuclear powers do not lose major conflicts on which their fate depends, and he also said this should be obvious to anyone, even to a Western politician who has retained at least some trace of intelligence. And that's not the only time that Russia has threatened nuclear war during their invasion of Ukraine. Back in April, Russia also warned of nuclear expansion if Sweden and Finland were to join NATO, arguing that Russia could use strategic nuclear weapons to defend territories in Ukraine. And the conflict that has no real end in sight has caused ripple effects across global supply chains and has significantly increased the likelihood of the US falling into recession. For example, Dimon stated that he believes interest rates, which are currently set at 4% in the US, are likely to rise well above 5%.
I actually think rates will probably go higher than 5%.
Higher than 5%.
That's my own view, because I think there's a lot of underlying inflation which won't go away so quick.
The mainstream narrative at the moment is that the underlying causes of inflation are subsiding and that the worst of inflation is behind us. And this has certainly been the case in the short term, with inflation declining from 9.1% in June 2022 to 6.5% recorded last month. And on a month-by-month basis, headline inflation has slowed to a halt, driven by energy prices declining after surging earlier in the year. In addition, China is beginning to open up after having long sustained COVID lockdowns, and many people view this as deflationary, as it will ease some of the supply side bottlenecks that have been plaguing American businesses over the past couple of years. But Dimon, like Ray Dalio, has a different view of these factors.
I think we've had the benefit of China slowing down, the benefit of oil prices dropping a little bit. I think oil and gas prices are probably going to go up the next 10 years. We're not investing enough in oil and gas to actually keep it low. And it's also a fragile system. So like one terrorist bomb, and you can see what can happen to oil prices. And so I think we should be very careful. And wages aren't going to go down that much. People left the workforce. China isn't going to be deflationary anymore. There are all these other factors taking place. So I think it may have to be more than that.
Firstly, Dimon believes that China reopening could actually be inflationary as they increase their imports, particularly of commodities used in manufacturing, and how that could drive increased costs for US companies which are importing goods from China. And while oil and other energy prices are coming down, Dimon sees this as being temporary. Essentially, Dimon sees oil increasing in price over the next decade due to a lack of domestic investment. And higher oil prices also doesn't fare well for the climate because poorer countries that can't afford the higher oil prices will resort to cheaper, dirtier fossil fuels such as coal. So while it may seem counterintuitive to some, Dimon believes that if the US was to invest more in oil production, it would actually be beneficial to the climate in the medium term. But also, on an economic basis, it would help to prevent another inflation spiral. But even if the US chooses to invest more in oil production, Dimon believes inflation will be coming back in a meaningful way in the near term, and that the Federal Reserve will need to continue raising rates above 5% to get it under control. But there is one other factor that Dimon is using to reach his conclusion that a recession is coming in 6 to 9 months.
If you look in the short run, the consumer is spending 10% more than last year and 40% more than pre-COVID. They're spending it in different things, so all you speakers up here, some are doing better, some are doing worse. That's a tremendous sum of money, and they have $1.5 trillion still in their checking accounts more than pre-COVID. So the spending is down. That's the good news. And the companies are in good shape too, by the way, and their balance sheet, consumer balance sheet is in great shape. The other news, which is not good, is that rates are now, 4% on their way to 5%. Inflation is eroding everything I just said, and that $1.5 trillion will run out sometime mid-year next year.
The enormous amount of liquidity created by the Fed during 2020 has boosted the amount of savings people have to the point where today, Americans still have $1.5 trillion more in their savings accounts than they did before COVID. But with high inflation and now higher interest rates, a lot of that is being eroded away. Higher interest rates means that households are paying more for their mortgages, and if they have other consumer debt, then they're paying more on those as well. And higher inflation has meant that even though they have more savings to spend, the cost of the items that they're buying, the goods and services they're buying on a week-by-week basis have gone up substantially. And according to Dimon, the $1.5 trillion of additional savings will be depleted during 2023. And then there's quantitative tightening, something that we actually haven't seen play out in a meaningful way ever before.
It's QT, which we've never had before. So therefore, the unknown effects, and you see it today in bond markets around the world and sovereign markets and people selling U.S. Treasury debt.
Quantitative tightening is the process of the Federal Reserve offloading some of the assets on its balance sheet. Currently, the Fed has about $8.5 trillion of government bonds, mortgage-backed securities, and some other financial assets. As they sell some of these bonds in the market, they're adding additional supply to the supply and demand balance, and that essentially drives down the price of bonds and can also drive down the bonds of other risky assets whose returns and prices are seen relative to bonds. Essentially, the additional selling of bonds mean that the yield of those bonds goes up, and that means that the desired yield on stocks also goes up, or in other words, the stock prices need to come down. But to understand it at an even easier level, the more that the Fed is selling bonds, the more money they're drawing out of the financial markets. But while these macroeconomic issues are very far out of our control, Dimon offers some guiding principles for investors trying to navigate the uncertain market conditions.
And the economy, of course, we all talk about it. It's like the weather. We don't really know, and I hate guessing about that. We should have a little humility. I've never seen anyone actually do it well.
The most important thing to recognize is that hardly anyone is able to predict economic events on a consistent basis because there are just too many unknowable factors. So Dimon says don't worry about the so-called economic weather, and instead focus on ensuring that you're protected regardless of a wide array of outcomes that could take place over the next 12 to 24 months.
I know there are going to be recessions, up, downs, and downs. I really don't spend that much time worrying about it. I do worry about poor public policy that damages American growth. I worry about a lot of stuff, but not about whether, what the weather's going to be like. And of course, I don't want a recession because it hurts average Americans. I'm not for it, but I have to be prepared for it.
And the same principles should be applied when investing in businesses. Because we cannot know for sure if the US will enter a recession, and if so, how long or severe it will be, it's better to focus on investing in companies that can survive a period of economic weakness. On the other hand, if you're investing in companies that need economic conditions to continue improving, or they need interest rates to go back down because they carry a lot of debt, then you're essentially gambling on economic factors that are well outside of your control and the business's control. Instead, focus on businesses in strong financial health and that have some kind of economic moat. An economic moat is some kind of unique characteristic that protects the business from competition. In its simplest form, if a business has a product or service that cannot be substituted for a competing business's product or service, and it's a product or service that the consumer needs, then you can be confident that that business is going to retain its customers even through difficult economic circumstances.